The world's most powerful countries, including nearly every global economic agencies, they are fully admitting in writing that we not only have structural challenges, but the true size of the value that is at risk is completely unknown. Of course, they've been telling us that for a while. We need to believe them. Actions always speak louder than words, but when their actions support their words, this is all due to the extreme level of leverage in the derivative products that frankly aren't backed by anything. They're just big bets. It matters because the bond market is the largest market that there is, far, far bigger than stocks. But sitting on top of this whole thing are big bets just based on these price actions. And that's why one of the big reasons why it's been so critical for the central banks to keep these bubbles floating. But now let's just jump right to the data because we're going to combine what we found with the OECD report and also what we found from the Office of the Comptroller of the Currency. And that's really what brings us all to you. Whether you think you're in the markets or you think you own bonds or you're not, I mean, this is going to impact everybody. What we really want to do is make sure that you are, number one, any negative impact is minimized for you and any benefit is maximized for you. Despite the significant increase of BBB rated bonds, there was a declining number of downgrades relative to upgrades, and that really is because they are mindful of downgrading BBBs. Because quite simply, there are certain entities like different pension funds, etc., that cannot invest in or put your money. These are entities that work with your money into below in investment grade bonds, right? So below BBB. Such rating stability concerns this is the part that I like. Well, I don't really like it, but you need to be the most aware of. Limit the ability of credit ratings to properly inform investors about the risks of individual bonds, because who pays the grading agencies like Moody's and S&P and other corporations that grade the bonds, that make that determination? And we have seen it before. 2008 was not that long ago, and they did exactly the same kind of thing, where they just kind of fudged the numbers. So it's not a big surprise that that BBB area has grown enormously from about 19% to well over 50%, and it continues to grow. But there are a lot of companies in that area that if they had used their original criteria and didn't fudge their criteria, would definitely not be investment grade. That's one of the structural pieces that you need to really be concerned with, because these rapid developments in the corporate bond market have revealed some structural. Look at all of this money for free actually encourage these corporations to go out and borrow more. Now, the Fed may or may not have actually thought this, but the Fed thought, well, let's lower the rates and then they can just convert that debt, roll over that debt that now they have to pay 10% or 8%, whatever that is, down to 4%. That will help them get out of debt and make the foundation stronger. But instead, did they roll that over? Yeah, they did. But instead, they grew even more debt because it takes the same amount of dollars to service a higher level of debt at a lower level of interest. It's kind of like what's been happening in the mortgage arena too. Prices can go up, payments remain the same or relatively the same because the interest is so much lower. But what that really has done is created a lot more vulnerability. So the first thing I want to talk to you about, and this is something that I bring up regularly, And the biz said, gold is the only financial asset that runs no counterparty risk. So let's get into this counterparty risk a little bit more deeply, because any contract with all Wall Street products, all of them, even the dollars that you hold in your wallet, are all contracts. And any contract is only as good as the counterparty to that contract. But the notional amount of a derivative contract is a reference amount that determines contractual payment, but it is generally not an amount at risk. So I go to you and I say, okay, I think the sky's going to be orange tomorrow. Let's make a bet. And what do we bet? We bet, I'll bet you $10. Now, if the sky actually turned orange tomorrow, that would probably be a huge problem, huge. And certainly its worth would be a whole lot more than that nominal number of 10. But I'm going to trade that back and forth, not knowing what the true risk is. The credit exposure is a function of the movement of the markets. In other words, the value of those derivative bets are based upon whether the stock market or the bond market or whatever the bet is written against, whether that goes up or down. And that's one big reason why we've seen the Federal Reserve and other global central banks, when markets started to pull back, they ran right in with lots more money to support that. And what they also did with all that liquidity was create other problems. So we've talked about the repo markets, the reverse repo markets, all that gobbledygook. Because remember, this stuff is intentionally made complex so that you don't question it. But what all of this money printing has done, and this is so critical for you to understand, what all of this money printing has actually done, it has pushed too much money in the markets, and that has become a problem. Because not only is it rising wealth transfer up here, but it's also rising complexity. So this next time, is anybody going to go to jail? Probably not. I mean, how are you going to figure that out? Good luck. I mean, honestly. That's why this is so important. Outside of the system, people, outside of this garbage system, because they want you to think that the only options you have are stocks or bonds. Not true. Not true.